Welcome to Griffonomics. Today we're diving into Snapchat, trading under the ticker SNAP.
It's definitely one of the most polarizing tech stories out there right now.
Oh, completely. Because, imagine a company that essentially prints $1 billion a year in cash, immediately sets that cash on fire just to stop its own employees from quitting, and still somehow manages to convince Wall Street that it's executing this flawless financial turnaround.
Right. It sounds impossible when you say it out loud.
It really does. But for anyone trying to understand, the mechanics of corporate restructuring, financial engineering, or just the sheer drama of the modern tech industry, this is a masterclass.
Yeah, it really is.
We are custom tailoring this deep dive for you, the listener, to answer one highly contested multi-billion-dollar question. Is Snap a classic, deep-value, asymmetric restructuring trade just waiting to explode to the upside? Or, and this is the scary part, is it a structurally impaired, highly dilutive melting ice cube that is just slowly, quietly destroying shareholder wealth?
And the divergence in opinion on Wall Street right now is staggering. Depending on which specific page of the financial filings you look at, you can build a highly convincing, totally data-backed argument for either of those scenarios.
Exactly.
But to get to the actual truth, we cannot just read the headline numbers. We have to perform a strict, uncompromising forensic audit of the mechanics operating beneath the surface of those filings.
And we have brought a massive stack of materials to the table to do exactly that. We're unpacking Snap's Q2 2026 earnings reports, their formal 10Q SEC filings, the raw earnings call transcripts, several detailed analyst deep dives, and an incredibly revealing interview transcript featuring activist investor Adam Katz of Irenic Capital.
Yeah, his campaign against the management team right now is highly unusual.
Fascinating.
Totally. Okay, let's unpack this. Looking at Snap right now is like looking at a house with a fresh, beautiful coat of paint on the outside. But when you look at the foundation, there's some serious cracks. Our job today is to figure out if those cracks are fixable or if the house is sinking. And, the management team is basically standing on the front lawn, pointing enthusiastically at that fresh paint, right? Hoping nobody brings a flashlight into the basement.
Right. Keep everyone on the lawn.
Exactly.
Right.
But a forensic audit requires looking at the foundation. So we have to start with the specific headline numbers that just sent the stock surging in the second quarter.
Because the mechanical variables behind that initial financial performance are genuinely impressive. Total revenue surged 18.9% year over year to $1.60 billion.
Which is huge.
Yeah. It beat Wall Street estimates by over $66.4 million. If you just stop reading the press release right there, it sounds like an unmitigated growth story.
It does. And the underlying P&L, the profit and loss statement, shows exactly why the market reacted with such initial enthusiasm. Management highlighted the GAAP gross margin expanded massively by 700 basis points, landing at 58%.
Wait, let's pause there for a second. For anyone rusty on the financial jargon, a basis point is just 1/100th of a percent, right?
Right, yeah. So a 700 basis point expansion means their gross margin jumped by a full 7 percentage points.
Which is massive.
It's incredible.
Yeah.
When you're operating at a $1.6 billion quarterly run rate, squeezing an extra 7% of profit out of your core revenue generation, that is a massive leap in underlying efficiency.
It indicates that the core cost of delivering the service, the cloud hosting, the data routing, all of that is scaling much better against the revenue coming in.
Exactly. But the metric that management was really promoting, the one heavily bolded in all their communications, was adjusted EBITDA.
Oh, yeah, the famous adjusted EBITDA.
Right. It surged an astonishing 505% year over year to $250 million.
A 500% increase sounds like the business model has fundamentally transformed.
It really does.
But you look one line down on the actual income statement, and the narrative kind of fractures. Because despite this supposed operational acceleration and this massive margin expansion, Snap still reported a GAAP net loss of $164 million for the quarter.
Yeah, that's the reality check.
There is a glaring mechanical disconnect here. How does a company claim a 500% surge in adjusted operational profits while legally reporting a $164 million accounting loss?
The disconnect stems from the brutal reality of corporate restructuring, which, of course, management has conveniently excluded from their adjusted metrics.
Right.
To understand that GAAP loss, we have to isolate a very specific event. In Q2, Snap absorbed $128.5 million in pre-tax restructuring charges.
And the mechanism behind that charge was a massive workforce reduction, right? Executed on April 15, 2026.
Yes. Management cut 16% of their entire global staff in a single day.
Wow.
We're talking about roughly 1,000 jobs eliminated instantly.
The human toll of that is intense, especially when you look at the historical timeline in these filings, because this wasn't just an isolated event.
Not at all.
This is Snap's fourth major reduction cycle in just 4 years. I mean, they slashed 20% of their workforce in 2022, then 3% in late 2023, another 10% in 2024, and now this 16% cut in 2026.
They are continuously amputating limbs just to keep the body alive.
That's exactly what it feels like. And from a pure accounting perspective, firing 1,000 people is incredibly expensive up front. That restructuring charge included $74.4 million in pure cash severance payouts.
Which makes the cash flow statement the most interesting document in this entire earnings release. Because despite writing $74.4 million in severance checks, the cash flow realities of the business are actually remarkably robust.
Oh, totally.
Operating cash flow hit $176 million for the quarter, and free cash flow reached $121 million. And this wasn't just a fluke. This actually marks Snap's 8th consecutive quarter of positive free cash flow.
I have to push back on that, though, because it creates this strange paradox. If they are generating all this free cash flow for 2 solid years and EBITDA is up 500%, why are they still reporting a $164 million net loss?
That's a great question.
It feels like counting your salary but completely ignoring your mortgage. Like, if you have to fire 1,000 people and you still lose $164 million in a single quarter, the basic unit economics of the company still look fundamentally broken.
What's fascinating here is how management uses the concept of operating leverage to kind of obscure that paradox.
Okay, break that down for us.
So, operating leverage is a fairly simple mechanical concept. It's basically what happens when your revenue grows faster than your operating expenses. Management loves to point out that they grew their top-line revenue by 19%, but they held their adjusted operating cost growth to just 4%.
Right, which sounds great on paper.
Absolutely. In a software business, when revenue outpaces cost growth by that kind of margin, every incremental dollar of revenue should theoretically fall straight to the bottom line as pure profit.
Makes sense.
So they are promising Wall Street that this operating leverage will result in sustained, positive GAAP net income by 2027 based on these aggressive cuts.
But the promise of 2027 profitability sounds great until you realize it requires ignoring the massive elephant in the room that explains that $164 million loss today. We really need to talk about how Snap actually pays the employees who survived those 4 rounds of layoffs.
Yes, we do.
Because the word adjusted in adjusted EBITDA is doing an enormous amount of heavy lifting here.
It is arguably the single largest optical distortion in modern tech accounting.
Yeah.
And uncovering it requires a strict forensic audit of Snap's equity compensation structure.
Let's do it.
That headline, adjusted EBITDA of $249.6 million that Wall Street cheered for. It literally only exists because management decided to add back $263.2 million in quarterly stock-based compensation expense.
So wait, let's break down the mechanics of what they just did. To claim a $250 million operational profit, management is essentially telling investors, hey, we paid our engineers and executives $263 million this quarter, but since we paid them in company stock instead of cash from the bank account, we're just going to pretend that expense doesn't exist.
Exactly. They treat it as a non-cash expense, so they pull it out of the adjusted profit calculation. But the dilution to the existing public shareholders is very real.
Very real.
The sheer scope of the printing press here is staggering. In just the first half of 2026, Snap recognized $513.2 million in stock-based compensation, or SBC.
$500 million in 6 months.
Yeah. And management's official guidance for the full year of 2026 is approximately $1.05 billion in SBC.
$1 billion in stock grants in a single year. To understand the gravity of that, we have to measure it against the actual size of the company.
Right.
Snap's total market cap, literally the value of every single share combined, is hovering around $8.8 billion right now.
Yep.
They are printing over 11% of their entire enterprise value annually just to subsidize corporate payroll.
It's wild. And if we connect this to the broader philosophy of Silicon Valley compensation, the original idea behind SBC was supposed to align employee incentives with shareholder value.
Right. You give a young engineer restricted stock units. If they build great products, the stock goes up, they get rich, and the public shareholders get rich alongside them.
Exactly. But at Snap, the mechanism has completely inverted. It is no longer an incentive. It's a structural subsidy. Because the stock price has languished for so long, they have to issue a higher and higher volume of shares just to hit the target dollar amounts they promised in those employees'
Yeah.
offer letters.
Ah, I see.
So they are continuously slicing the pie into smaller and smaller slivers for the public shareholders, just to keep the employees whole.
Which directly leads into this totally frustrating financial maneuver for any traditional value investor reading these filings, which is the buyback treadmill.
Oh, the buyback treadmill.
Yeah. So management highlighted that in the first half of 2026, they repurchased 98.5 million shares of their Class A common stock,
Right.
and they spent $601 million in cash to do this. Now, normally the traditional logic of a stock buyback is that a company uses its excess cash to retire shares. By reducing the total number of shares in existence, each remaining share becomes rarer, right?
That's the textbook theory.
Yeah, it represents a larger percentage of the company's earnings, so it's supposed to make the stock price go up. But Snap's net share count isn't actually shrinking.
Not at all, because that $601 million wasn't deployed to reward shareholders. It was a purely defensive maneuver to mop up the massive wave of new shares they just printed and handed to their employees.
They aren't buying back stock to make the listener's shares more valuable. They are running on a treadmill just to stand still.
Literally just trying to tread water.
Right. They spent $601 million in cash simply to neutralize the employee equity vesting rather than actually reducing the net share count.
And it fundamentally recontextualizes that whole 8th consecutive quarter of free cash flow metric we talked about earlier.
Completely.
Because what good is generating free cash flow if 100% of it must be used to offset the dilution caused by your own payroll?
It's meaningless.
Right. And frankly, the historical context shows they aren't even running fast enough to stay in place. Since the 2017 IPO, original public stockholders have experienced a cumulative 70% dilution.
70%.
Yeah. The cumulative damage is the true hidden liability here. Snap has issued over $8 billion in cumulative stock-based compensation since going public.
That's insane.
That figure is nearly equal to the company's entire current market capitalization today. Mechanically, they have effectively transferred the equivalent of the entire value of the company to their employees over the last 9 years, leaving public shareholders to completely shoulder the dilution.
I mean, you can theoretically outrun that kind of massive dilution if your user base is growing infinitely and getting wealthier, right? You just grow your way out of the problem.
Theoretically, yes.
But a look at Snap's demographics in these filings shows a terrifying geographic erosion that makes that growth narrative highly improbable.
Right. Because if you just glance at the very top of the earnings release, Snap projects this incredible global scale. They report 971 million monthly active users and 493 million daily active users.
Approaching 1 billion monthly users puts them in a highly exclusive tier of digital platforms.
It does. But we have to reconcile that global headline scale against the severe underlying geographic reality. In the digital advertising business, a user in one hemisphere is not economically equal to a user in another.
No, they aren't. And that geographic reality creates a terrifying mismatch for Snap's business model. They are actively losing their grip on high-value Western markets.
Yes, we have to map out this deterioration because it's stark. In Q2, North American daily active users dropped 6.1% year-over-year, falling to 92 million.
Ouch.
And Europe contracted as well, down 2.0% year-over-year, slipping to 98 million DAUs. These are the demographics that possess high disposable income. These are the exact users that major brands actually want to pay premium advertising rates to reach.
And contrast this against the rapid growth in the rest of world markets, because DAUs in the rest of world grew an impressive 11.8% year-over-year to hit 303 million.
Right, the volume is growing there.
But this demographic shift creates a brutal economic margin squeeze. Explain the ARPU chasm here, because it's wild.
Yeah, ARPU, average revenue per user, is the mechanism driving this squeeze. In North America, Snap generates $10.26 in revenue for every single user.
Okay, 10.26.
But in the rest of world markets, they generate an anemic $1 per user.
So they are bleeding users who generate $10 and replacing them with users who generate $1.
Exactly. But the math is actually much worse than a simple revenue decline, because those $1 users cost a fortune to support. This is what the analysts refer to as the infrastructure trap.
Right, the infrastructure trap. Explain the why behind that.
So the infrastructure trap is entirely a function of Snap's core product design. Text-based platforms like X or a traditional web form are incredibly cheap to host. Text is light.
Right.
But Snapchat is a heavy, visually dense application. The core user behavior involves applying augmented reality lenses in real time, recording high-definition video, and routing those large media files to millions of phones globally.
So every single new user in the rest of world costs Snap tangible money in heavy video routing and bandwidth obligations. Exactly. Across Amazon Web Services and Google Cloud, those server computes add up fast. You are paying premium Western cloud computing prices to route heavy video files to a user in a market where local advertisers are only willing to bid pennies for the ad impression.
It's just a broken equation. The more users they add in these regions, the more their margins degrade.
Right. And this dynamic actually forced management to raise their full-year 2026 infrastructure cost guidance by $50 million. They are now projecting they will spend between $1.65 billion and $1.70 billion this year just to keep the servers running.
Which is just a massive anchor on profitability. And it brings us to the core software flaw, holding their advertising growth back to just 9.3% year over year. While Meta is printing record profits, Snap is stuck. And it's because of what performance marketers call the intent data deficit.
The intent data deficit is critical to understand here. To really grasp it, you have to compare Snap's architecture to its competitors.
Right. When you use Google search, you are directly handing the algorithm your commercial intent. If you search for best wireless headphones under $200, Google knows exactly what you are trying to buy in that exact moment.
Sure. And even on Instagram, the algorithm tracks every reel you watch, how long you linger on an image, what accounts you follow. It builds a permanent, highly detailed graph of your consumer psychology.
Exactly. But Snap's entire brand identity was built on ephemeral messaging. Disappearing messages generate zero persistent commercial intent data.
If a teenager sends a disappearing video to a friend, there's no context to scrape, no consumer intent to catalog, and the data literally vanishes from the server almost immediately.
Right. An advertiser cannot build a targeted performance marketing campaign around a 10-second selfie. Snap simply lacks the persistent data layer required to train modern, high-converting ad algorithms.
Which explains their absolute desperation to partner with Perplexity AI, because the sources detail this fascinating timeline regarding this failed integration, which is clearly a massive attempt to finally solve that intent data deficit.
Oh, the Perplexity deal. Yeah, back in November 2025, Snap signed a landmark $400 million deal to embed Perplexity's conversational AI search engine directly into the Snapchat interface.
The initial hypothesis was brilliant, honestly. Wall Street initially modeled it as a major catalyst.
Because the mechanical goal was that users would treat the AI like a search engine within Snap. They'd ask it questions, research products, ask for recommendations.
And suddenly, Snap would possess high-value search queries. They would finally have the intent data required to serve sponsored AI links and integrate deep e-commerce advertising.
But the execution was a complete failure. By February 2026, just months after the announcement, Perplexity executed a massive strategic pivot. They completely abandoned their native advertising business model.
Wait, really? Just abandon it?
Yep. Perplexity's management decided that injecting sponsored links into AI responses degraded the objectivity and trust of their search engine, so they just stopped.
But that instantly shatters the fundamental premise of the partnership. Snap requires advertising to monetize its platform. If Perplexity flatly refuses to run ads, the deal is dead.
Exactly. But the friction wasn't just limited to the business model. The software integration itself was deeply flawed. When the Perplexity engine was pushed live into the Snapchat mobile interface, the AI began hallucinating heavily.
Yeah, the activist investors pointed out in their presentations that the integration was producing what they called AI slop. Just erratic, low-quality responses that actively degraded the user experience.
And when you push erratic AI slop to a demographic where the vast majority of users are under 34 and a significant portion are minors, you invite massive regulatory scrutiny.
Unleashing an unpredictable web-scraping AI bot into the pockets of teenagers became an immediate legal liability.
Or absolutely. Regulators in the U.S., and specifically the European Commission under the Digital Services Act, began heavily scrutinizing the integration for youth safety violations.
So by early May 2026, the entire $400 million deal collapsed. The contract was terminated, and Snap management was forced to completely scrub that projected revenue from their 2026 guidance.
Which was a huge blow.
So what does this all mean for the listener? We have to step back and look at the whole picture here. The high-value Western users who actually make them money are leaving. The remaining users are too expensive to support due to cloud routing costs. They can't figure out what the users actually want to buy because the messages disappear, and their massive $400 million AI search lifeboat completely sank.
Right.
So, how did revenue surge 19%?
This is exactly where the story pivots.
Yeah.
Because Snap realized that core lower funnel ads weren't enough. They were structurally disadvantaged. So they aggressively pivoted to build a high-margin consumer software lifeboat completely independent of the ad market.
The direct revenue engine. The financial results of this pivot are buried in the other revenue line item in the 10Q filing, and the growth rate is phenomenal. I mean, other revenue surged 85% year over year to $316.5 million for the quarter.
It is a remarkable pivot in monetization strategy.
Yeah. We are looking at a consumer software subscription business that has rapidly scaled well past a $1.2 billion annual run rate.
And if we deconstruct the mechanics of that specific revenue tier, we find three distinct engines monetizing their power users. First is Snapchat Plus S, which offers users early access to experimental platform features.
Right.
Second, they introduced Memories Cloud storage plans. And this is perhaps the smartest operational maneuver in their recent history.
Oh, I agree.
For a decade, Snap absorbed the massive server costs required to host billions of saved photos and videos for free. Now, they are charging their heaviest users a monthly subscription fee to store that media. They literally turned a massive server cost center into a recurring cash generator.
Brilliant move. And the third engine is their newly launched Lens Plus tier, which provides creators with premium generative AI tools directly inside the camera interface. And the penetration runway for these subscriptions represents the core bull case for the stock right now, because currently, less than 3% of their monthly active users are actually paying for these services.
Which leaves a massive upside.
Huge. Expanding toward management's 7% to 12% industry penetration target provides this multi-billion-dollar recurring cash cushion that is totally insulated from macroeconomic advertising cycles.
And more importantly, it's entirely immune to the structural tracking limitations imposed by Apple's privacy changes to the iOS ecosystem.
Yes. But the internal AI story at Snap didn't end with the Perplexity failure either. They simply stopped trying to use AI to generate ads and started using it to ruthlessly slash their own operating costs. The internal AI efficiency revelation they reported is staggering.
It really is. Snap replaced the external Perplexity deal by turning all their AI engineering resources inward. The mechanics of how they're deploying these internal AI multipliers demonstrate a fundamental shift in software engineering.
Walk us through the numbers on that.
Snap is utilizing autonomous AI tools to generate 65% of all new code commits within the company.
Wow.
And even more impactful, AI agents are now conducting the initial review for 90% of all pull requests from human developers.
Okay, for those unfamiliar with the software development cycle, a pull request is the traditional bottleneck in engineering. When a developer writes new code, it cannot just be pushed live to a billion users. Another senior human developer has to manually read that code, check it for bugs, and ensure it integrates safely with the rest of the app.
Right, and that manual review process consumes millions of hours across the tech industry. By deploying AI to automatically review 90% of those pull requests, management estimates they are saving 30,000 developer hours every single month.
That's incredible. They are automating the actual construction and maintenance of the app itself.
But here's where it gets really interesting. This internal automation extends far beyond just writing code. Snap has automated 90% of their ad moderation reviews. Furthermore, AI support agents are now fully resolving 62% of all customer support inquiries, autonomously handling nearly 4 million support tickets a month without human intervention.
This internal AI multiplier is the exact mechanical reason Snap was able to achieve that operating leverage we discussed earlier. It is exactly how they grew revenue by 19% while holding adjusted operating cost growth to just 4%.
Exactly. You do not need to hire 1,000 new mid-level engineers or customer support reps if an autonomous AI agent is writing the code, checking the code for bugs, and answering the user complaints.
Right. And they essentially rebuilt the machine learning architecture, powering their lower funnel ads, which drove a massive 56% year-over-year increase in direct response ad conversions.
The underlying software engine is actually performing significantly better.
So let's summarize the exact position the company is in at this moment in our deep dive. They executed a 16% headcount reduction. They utilized AI to automate massive portions of their coding, ad moderation, and customer service. Their ad conversions are up 56%. And they convinced millions of users to pay for cloud storage, scaling a billion-dollar recurring subscription business from scratch.
By all traditional financial metrics, they should be a cash printing machine.
Exactly. So why is the stock stuck at $5?
Because they are pouring that cash into a multi-billion-dollar gamble. The cash generated by that highly successful software turnaround is not being returned to shareholders or dropped to the bottom line. It is being aggressively funneled into Specs Inc.
Ah, the hardware distraction. This is the ultimate point of friction for investors. We have to deep dive the commercialization of Specs Inc. and its multi-year strategic silicon partnership with Qualcomm's Snapdragon XR.
Snap has spent over a decade developing augmented reality smart glasses, and the R&D burn rate is phenomenal. Our sources note that Snap has spent roughly $3.5 billion developing this technology.
$3.5 billion.
Yeah, and they finally unveiled the newest iteration of the Specs AR glasses this quarter. If we audit the hardware from a purely technical standpoint, the specifications are genuinely groundbreaking.
The tech specs versus reality.
Right. These are fully standalone see-through AR glasses. They feature deeply integrated agentic developer tools. They have embedded large language models like Claude Code, Codex, and Cursor directly into the hardware ecosystem.
Which theoretically allows developers to build complex AR applications using basic natural language commands. The engineering achievement sounds like science fiction.
It does, but then you drop the hammer on the commercial reality.
Yeah, they slapped a $2,195 retail price tag on these glasses, over $2,000 for a pair of AR glasses from a company known for ephemeral selfies.
It was a tough sell.
And the consumer launch event is coming up on September 16th, 2026 in LA. Yet, during the earnings call, management openly admits mass market consumer adoption will not occur until roughly 2030.
Which unpacks the entire strategic debate for investors.
Right. Is this a $3.5 billion sunk cost hardware distraction that is dragging down a perfectly good software company?
Right.
Or is it a necessary survival attempt to own the next computing platform and finally escape the mobile operating system sharecropping trap imposed by Apple and Google?
It feels like Snap is running a highly profitable corner store, but taking all the profits every single night and buying lottery tickets, hoping to build a mega mall across the street. Even if they are right about AR, can they afford to wait until 2030?
And that exact frustration is what has brought activist investors to the gates, trying to force management to stop the hardware burn.
Which brings us to the activist siege led by Adam Katz and Irenic Capital Management. The sources include this fantastic transcript from a podcast interview with Adam Katz, which leans into his fascinating background.
Katz's philosophy dictates his entire approach to this campaign. He holds a JD MBA, and he spent a decade working at Elliott Management, which is widely considered one of the most aggressive activist hedge funds in the world.
During the interview, Katz explains that he views financial markets not simply as abstract economic ecosystems, but fundamentally as strict legal constructs.
And he heavily emphasizes this concept of intellectual humility. He argues that humans are inherently terrible at predicting the future. You cannot reliably predict if consumers will want to wear $2,000 AR glasses in 2030.
Exactly. Because you cannot predict the future, Katz believes investors must rely on magic manual effort. You don't guess what the market will do, you roll up your sleeves and manually force change today through corporate governance.
But there is a fatal flaw in Katz's campaign against Snap. We have to reveal this corporate governance wall because it is impenetrable. Explain why Irenic's demands face this legal roadblock.
The mechanism is a multi-class share structure. Co-founders Evan Spiegel and Bobby Murphy hold over 99% of the total voting control of the entire company via their Class C supervoting shares.
So over 99% of the voting power rests with two people.
It creates a supreme irony in this activist campaign. Katz's entire professional background is rooted in leveraging minority shareholder rights, as he discussed in his podcast. Yet at Snap, the public Class A shareholders have literally zero votes.
None whatsoever.
Katz can only win through persuasion, not proxy battles. He cannot vote to fire Evan Spiegel.
It's a total governance impasse. But we also have to shift to the other existential threats Irenic is worried about, which is the looming regulatory and legal litigation overhang.
The legal overhang is significant. And to carefully and impartially detail the facts found in the sources without taking a side on the legislation itself on the regulatory side, the Sixth Circuit Court of Appeals has recently reinstated Ohio's mandatory parental consent law, specifically targeting minors under 16.
Which means any platform operating there must implement robust age verification systems, which historically reduces daily active user counts.
Furthermore, there are active European Commission Digital Services Act, or DSA, investigations heavily scrutinizing minor safety protocols.
And then there's the civil court system. There's an escalating volume of product liability claims regarding minor safety. The sources highlight critical upcoming October 2026 JCCP bellwether trials in California.
Right. A bellwether trial is essentially a legal stress test that sets the financial settlement values for thousands of other pending cases.
So if you have a CEO who can't be fired because of his voting shares and an upcoming October trial that could change the fundamental liability of the platform, how do we price that risk?
Pricing that exact risk is how we reach our final verdict on the stock's valuation.
Let's lay out that valuation synthesis. Snap is currently trading at roughly $5.25 per share. That values them at roughly $18 per DAU compared to $241 for Reddit and $393 for Meta. And they are trading at roughly 1.2x EV sales.
Which is incredibly low for a software company. So delivering the final verdict on whether this represents deep value. Mathematically, the activist argument holds water. If Snap simply enforces basic cost hygiene, scales its $1.26 billion subscription business, and contains the specs hardware bleed, it doesn't need to become Meta to yield a massive cyclical recovery.
Right.
However, the execution risk rests entirely on the shoulders of a CEO who answers to no one. You are betting that Evan Spiegel voluntarily chooses fiscal discipline over his AR ambitions while navigating a complex legal gauntlet.
And that's exactly why you, the listener, should care about this story. This is a masterclass in how GAAP accounting, dual-class share structures, and technological shifts can disguise the true health of a business. It's applicable to any tech stock you might be looking at.
Absolutely. You must trace where the cash and the equity are actually flowing.
I want to leave you with the final provocative thought to mull over. We discussed how AI is already writing 65% of Snap's code and reviewing 90% of their ads. What happens to the value of a tech company when the cost of software development essentially drops to zero?
It's a huge question.
If anyone can build a social network for pennies, does the value shift entirely to the physical hardware? Meaning Evan Spiegel's multi-billion-dollar gamble on specs might actually be the only thing that saves them in the end.
If the software layer is entirely commoditized, the physical hardware moat becomes the only defensible asset left.
Something to carefully consider.
Yeah.
Thank you for joining us on this deep dive, and keep questioning the numbers.